Before this year started, you probably had a portfolio based on how you thought this year would go. Some stocks, some bonds, maybe some index funds, and at this point of the year, things have absolutely changed. Tariffs have changed how the stock market has looked. We went from a positive stock market in 2024 to a down stock market so far in 2025, and it has us wondering, what if we could change our entire portfolio? What if we could wipe the slate clean and start over from zero? Well, that is what I am here to answer for you. If I had to build a portfolio from scratch, knowing what we know right now and building from what we have knowing in 2025, how would I start a portfolio? Let's go ahead and break it down. Now, I'm going to give you this disclaimer because it is important. This is my portfolio based on my risk tolerance, and everybody is going to be different. Everybody's portfolio is going to be different. I'm going to give you a little bit of modification or modifiers, if you will, kind of switch things up, but I am 35, all right? I got some years before retirement, hopefully, and you may be 5 years from retirement, 10 years from retirement, or 30 years from retirement. So make those modifications however it is that suits you, all right? And my risk tolerance, I would say, is probably higher than most, but again, that is how I am approaching it. Also, because of tariffs and because of how the job market is, because of what I expect to happen this year, like, it wouldn't shock me if we're going to be in a recession. It wouldn't shock me if the stock market continues to be choppy. This is not a normal portfolio, okay? So I'm giving you that up front. So here's what I would start the portfolio with. I would start off with 10% in cash. Now, I'll also tell you this. This should work regardless of what the amount is. So $100,000, $1,000, even $100. Also, with this portfolio, I would start off with these percentages and continue adding to it. All right, so that's one other caveat. Now, again, 10% I would start off in cash. Now, in most scenarios, I would argue, like, if I was back in my advisor seat and you came to me and said, oh, I got 10% in cash, normally I'd say, that's a lot of money to have in cash. You would want that money to be working more for you and in the market, just gaining more interest. That's what I would tell you. Except that in 2025, with tariffs doing what they're doing, you're going to be losing more money in most cases. Now, as a long-term investor, yes, we should still be investing, which is why it's only 10%, not 5%. Now, in a normal market, maybe 5% makes more sense, but because you may experience job loss because the market is a bit choppy, and right now you can get a high yield savings account earning you close to 4%, that might be okay. All right, so 10% for me in cash, I think makes a lot more sense. So 10% is in cash, higher than what I would say last year, but in a year like this, for me, this is mine, right? 10% is where I would go for cash. Now, 80% of my money, I would move to stocks, and that is me. I might be more aggressive than most, but how? How is this money going to be divided into stocks? That is the big question here. Now, there are two ways we can do it. I'm going to show you the way, one main way, and then an alteration to it. This is one of those modifiers. Now, the first way is 60%. So within the 80%, we're going to break it down even further. Okay, so 60% is going to be in a U.S. index fund. Now, my favorite one is ITOT. I think that is the S&P, the iShares S&P 500. I'm sorry, the iShares U.S. Total Stock Market Index Fund. That's essentially all the stocks in the U.S., just to make it super simple. Okay, again, the ticker symbol ITOT. Then you can take an international fund, so you got all the stocks in the U.S. and all the stocks outside of the U.S. Now, obviously, if you take this route, 60% of your stocks aren't going to make money right now, at least right now. Hopefully that'll improve. Will it improve by the end of the year? I doubt it, but that is possible, all right? Now, also, the other side of that, 60% is in U.S. stocks. The other 20%, okay, 80% total in stocks, 20% can be in international stocks. That's IXUS is the ticker symbol there. That's the iShares International Fund, so it's non-U.S. stocks. That's pretty much most of the stocks not in the U.S. Now, normal cases, I'm not the biggest fan of international stocks. I'm not anti-international stocks or anything like that, but usually U.S. stocks vastly outperform international stocks. Quick time out. I know we've been talking a lot about investing today. However, if you don't know where to start or you haven't started yet, I have a free guide on how you can buy your first stock in just 20 minutes. To get that free guide, check out the link right here. All right, back to the video. Except that the question was, what do I do in this time, in this year? And 20% U.S. stocks, you could argue more, might make more sense. But here's the thing. People are selling U.S. stocks. U.S. stocks don't make a whole bunch of sense. And to date, year to date, 6% is the gain for international stocks, and U.S. stocks are terrible right now. So if you want to overweight yourself, meaning put more money into international stocks, that actually may make a lot of sense. If you want to say 50-50 U.S. to international, you absolutely could. But again, we don't know how the tariffs are going to weigh out both now and in the future. There have been cases where international stocks have been really, really bad, but the U.S. stock market has been good. So, that's why I'm doing 60 U.S., 20 international for the 80% section of stocks. I'll try and put that on the screen. All right, so that's one variation of what we can do with the stock section. Okay, if you want to do just index funds only, that's the easiest combination that you can do. Now, let's say you don't want to do international funds and you just want to do just U.S. stocks or something like that. You could do 60% in index funds. Okay, that means the ITOT. You stick with the U.S. index fund and do that. And then you can break down and do individual stocks on top of that index fund. Now, the risk here is this index fund is going to have some of these stocks in it anyway, but you are hopefully trying to get a bit more gain out of this. You're taking more risk here, if you want to take that risk, but you're trying to get more gain out of this. So you could say 5% in Dollar General. Okay, we expect Dollar General to do well. It has been doing well so far this year, up about 26% year to date. Because of how bad the market has been, people are kind of flocking towards Dollar General, and they are recession resistant, and they have been tariff resistant for a lot of strategic reasons. If I haven't released that video, that video is going to come out later this week. Spoiler warning. Netflix. I've talked about Netflix. You can put 5% in Netflix. In this example, I would put 5% in Netflix in this example, and that's because I've been on Netflix for quite a while, and I've been telling y'all. Also recession resistant for a myriad of reasons. How are you going to tariff a subscription service anyway? Next is Take-Two Interactive, video game publishing company, also doing quite well. That one I would not have had on the bingo card, but still doing strong so far this year. And then you could also throw Kroger in there too. Perhaps you want to sub Kroger for Walmart if you choose, but that is Dollar General, Netflix, Take-Two, and Kroger. So that together is 20%. So 20% you can either do between those four stocks, or you can take that out and sub it for the international stock fund. Whatever combination. You want to take more risk, choose the 5 stocks. You want to take more of a conservative risk and hands-off approach, then you can take the international fund. Or whatever combination you want, okay? It is your portfolio, your risk tolerance. Totally up to you, all right? So, personally, I would probably do international stocks. It's just, I'm more risky. That is just me. And that's just because of my background. I do this all the time. This is my job, okay? And I just feel more comfortable doing that. And for me, right, my economist brain, it takes me a lot more energy to study what's happening in Europe, what's happening in Asia, and everywhere else to understand the history of international funds and how they may integrate into U.S. stock market, and then figure that combination out. I can do it. I absolutely could. Do I have the energy to do so? Yeah, right? But international funds, there is absolutely a case. I don't want to write that off. I'm just telling you what works for me personally. Okay, so consult your advisor, see if that makes sense for you. But there's absolutely cases, especially in a year like this. And then you can do 10% in bond funds. Now, how you do your bond funds, totally up to you. BND is usually my go-to because it's a U.S. bond fund. There's a case for international bonds as well. You can split that up 5 and 5 if you want, or whatever combination. I just usually go to BND. I'm just honestly lazy. I'm not the biggest fan of bonds and haven't been for quite a while, but that's what the textbook tells you. In all, that is for me, based on this portfolio as a whole, that's about 80% in stocks and then 20% in cash and bonds. And for me, on my risk tolerance, that is about where I should be, right about where I should be. Anywhere between 80 to 85% is where I should be for somebody who is 35 relatively moderately aggressive. So that is where I should be, and that's kind of where I want to be. Now, come June, because this is a new portfolio for me, I probably wouldn't make any adjustments until December-ish, maybe even, July, or not July, until 2026, because that's how I won't let it go for 6 months. So probably actually October is when I'm gonna come back and look at this for me. But that is what I would do if I had to erase the board and start over right now. And my objective is have something that is balanced based on where I am, have something that has tariffs and volatility in mind, and then invest in it and have it long enough to have some good informed observations. What I don't want to do is buy these investments now, change them next week, change them next month. That's a big mistake that people are going to make, and that's not what a portfolio is. That's trading. Trading can be very dangerous and very costly for anybody to make. It is very difficult to choose what to buy, what to sell, when to get in, when to get out. That's 4 different variables that you have to get right in any point in time, okay? Versus let me get these things and hold on to it and then see how they do and use all of the information in the past 6 months, make tiny tweaks. Wait another 6 months, make all of those observations, which at that point would have been a year. 2 6-month periods, entire year, and then make those observations. Okay, so that is how I'm looking at it. The 4 stocks that I chose, you don't have to have it at all 5%. You can change it up. Okay, I just did the math to make it easy, but for me, I do like to keep the number of stocks low. Okay, I want to keep the number of stocks low, and that is because I don't want to have to do and exhaust myself with, more than like 12 different stocks, because it's a lot of different research, a lot of things to keep track of, and a lot of different things to try and rebalance, because I don't want to have more than 5%. Let's say things go well for me and Netflix takes off and that becomes 8, 9, 10% of my portfolio. Though that's great, I don't want to have too much risk in those. I want to keep things relatively balanced, and that math can get very difficult. Then I got to pull out the spreadsheet. Right, and that gets complex, or can get complex, depending on if your app can balance it for you. So that is how I would balance my portfolio: 10% cash, 80% stocks, and then 10% in bonds. And then how you change up those stocks is the biggest part. Some studies say 90% of your results, your gains, are going to come from how you allocate, how you change up your portfolio. That is going to be one of the most important things. You want to learn more about investing and more about what can happen and how to protect yourself in a time of a potential recession and when the market is down, you want to check out this video right here.